The Fed just hit the reset button on the US economy, and the result is going to be a massive asset crash and a big recession that you all need to be preparing for right now. And let's just start this video off with a concrete example of why higher inflation and why the Fed increasing interest rates to combat inflation is going to cause a big crash. And what we're looking at on this graph, everyone, is the 6-month government Treasury yield. So if you were to buy a 6-month government bond right now, you would get about a 3.7% annualized return. Now, that's great, everyone. You can buy a government bond and actually get close to a 4% return. That's pretty good. However, this is actually a big problem for real estate in particular, and particularly real estate investors, because we can see now this 6-month Treasury yield is now almost at the same level as the cap rate for single family homes in America, aka how much an investor gets from buying a house and renting it out, 4.5%. That's now barely above what someone can get from buying a government bond, which means we are going to see a huge drop in real estate investor demand in America, and we're going to see a huge sell-off of real estate investors in America, because real estate is now a bad investment due to the fact that interest rates have gone up so much. The risk reward doesn't make any sense. Why would you buy a house and rent it out and spend all the time and take all the risks associated with that if you can get the same return from sitting on your couch and buying a government treasury? And the answer is you wouldn't, particularly for these big Wall Street real estate buyers. Their capital is being shut off as we speak. The pension funds, the life insurance companies that gave them their equity, the big banks that gave them their credit facilities, they're saying to these big Wall Street investors, no more buying. And that's just the first step. The next step for these Wall Street investors is margin calls, where their equity and their lenders say, hey, you need to pay us back. That's coming in future months as well. And this all has to do with the Fed increasing interest rates, higher bond yields. These higher rates and yields are deterring investment in real estate and encouraging saving, which is actually a good thing. I think we need more people saving money in America. However, there is a downside to these higher interest rates, and that's that they're also deterring business investment. Like home builders are cutting back on new housing construction. Venture capital firms aren't giving as much money to new VC startups because of the higher interest rates. We are now seeing a deleveraging across the entire economy due to these higher interest rates, which is going to cause a recession. It's very important for people to understand that while these Fed rate hikes are needed to combat inflation, they are something that will definitely cause a recession. Because if we look back into history in America over the last 70 years, you can see that every time the Fed increases interest rates by more than 1.5 points in a year, like they did in 2008, 2000, 1989, 1981, 1973, 1969, 1958. Every time the Fed does that, you can see there's a recession. These yellow bars, a recession occurs within the next 12 months. And here in 2022, after the next Fed rate hike, the rates will have gone up by about 3% year over year. Historically, when we reach that type of rate hike, a big recession almost always occurs. And by a recession, we're talking about, a surge in unemployment, a surge in layoffs, wages are going to start stagnating. And I think one thing that has kind of seduced some people into thinking that we're not going to have a recession or the economy is still strong is the fact that the labor market is seemingly still strong. The unemployment rate of 3.7% is still near a record low. I've noticed a lot of people who are looking to buy real estate or trying to buy stocks, they're trying to convince themselves that, oh, the economy's not that bad, it's not going to be that bad because of the low unemployment rate. But you got to understand, everyone, a low unemployment rate is very normal for this period in the economic cycle where we're getting whiffs of a recession, where the Fed is hiking rates, where inflation is high. It's typical that the unemployment rate is still low. If we go back to 2007, we can see the unemployment rate was in the low 4% range for a long time before it started really spiking in the middle of 2008. And historically, typically, it takes about 12 months. After the unemployment rate bottoms, it takes 12 months for the unemployment rate to start surging during the recession, which suggests that maybe in the spring of 2023 is when we're going to see all of a sudden like real issues in the labor market, like maybe a Lehman Brothers type situation occur in the labor market in the spring of 2023. And I say this not to scare anyone out there, but to give everyone a realistic sense of what is coming, our best bet of knowing what's going to happen in the future of the economy so you can make a better decision about what to do with your money and your investments, is to look into the past. And in particular, when I study previous economic downturns, there's one recession that really sticks out to me over the last 100 years as something that could have a very big parallel to what's occurring here in America in 2022. And that would be the Depression of 1920 to 1921. This is something that occurred after World War I and actually after the last pandemic, the Spanish flu. I think we could be seeing a similar economic situation play out. According to Wikipedia, the Depression of 1920 was a sharp deflationary recession in the US, the UK, and other countries around the world beginning 14 months after the end of World War I. This recession was characterized by extreme deflation, the largest one-year percentage decline in around 140 years of data. Wholesale prices dropped by 37% and the unemployment rate went up to over 10%, according to some estimates. And I actually think we could see deflation going forward in this economy, which sounds crazy at first, right? Inflation's at a 40-year high, 8.3% year over year. We had a hotter than expected inflation report in August. But stay with me, folks, because I think deflation could be a realistic outcome that you all should start thinking about. Because when we take a look at, for instance, commodity prices, whether it be oil, copper, aluminum, lumber, the prices of these commodities have crashed over the last 6 months by anywhere from 14 to 41%. At the same time, the housing market's crashing. Home sales are now at an 8-year low, and home prices are now going down across America, according to Redfin's median home sale price. These are deflationary warnings, basically saying that demand across the world economy has gone down significantly. There's been a lot of demand destruction over the last 6 months. Even before the impact of the Fed interest rate hikes was really being felt, we had home builders starting construction on fewer homes. We had manufacturers demanding less copper and aluminum to make new products. We have Americans driving significantly less, demanding less gas, and thus demanding less oil, causing oil prices to go down. Deflation is already here, actually, in certain sectors of the economy, particularly the physical goods economy, hard assets, and in particular, hard investments. We talked about housing. Well, what about gold and silver? These are two classical hedges against inflation. If we were going to have long-term inflation over the next couple of years, we would expect gold and silver prices to be going up. However, they've done just the opposite. Gold is down 12% over the last 6 months, while silver is down 23% over the last 6 months. And oh yeah, Bitcoin, another supposed inflation hedge, is down 54%, while cash is dramatically outperforming all of these. And so we have a commodities crash, a housing crash, and a precious metals crash all in the last 6 months. That says there's deflationary forces ahead, just as the Fed is aggressively hiking interest rates. This is the fastest interest rate hike regime we've seen in over 30 years. The 6-month Treasury, everyone, this is going from being 0%, yielding nothing, to yielding almost 4% in a matter of half a year. That's going to heavily incentivize saving in the economy. It's going to discourage spending, which is further going to contribute to demand destruction. And the result is going to be a big economic crash, everyone, because we basically have an economy that over the last 2 decades got addicted to artificially low interest rates. And those artificially low rates did cause a lot of investment into the economy, but a lot of that investment was something called malinvestment. It was into companies or industries that were not necessarily the most productive, but were worth investing in because interest rates were so low. I mean, think of all of the tech companies that boomed during the pandemic that make no money, that had crazy valuations. That's a sign of malinvestment. And now that these rates are skyrocketing so fast, I predict that the capital used to invest in businesses and manufacturing is going to get sucked out of those industries, and it's going to go into money market funds, it's going to go into CDs, it's going to go into government treasuries. It's going to make the demand destruction even worse, which is going to cause huge layoffs and cause the unemployment rate to surge. So how do you protect yourself from this outcome of the asset crash and then the layoffs and the recession? What's the best thing for you all to do out there with your money and your career? And from my perspective, stockpiling and hoarding cash is the number one thing to do. And that could either be cash in a bank account, or it could be cash now that's invested in some of these short-term securities like the 6-month US Treasury. You can get 3.7% annualized return from a relatively risk-free short-term US Treasury. That's almost as much as you would get from investing in real estate in the average market in America. No, yeah, it's actually more than you would get from buying and renting out property in Dallas, in Austin, in LA, in Seattle, in Salt Lake, and Denver. Buying and renting out real estate in those markets is actually less profitable than you simply sitting on your couch and buying a 6-month government Treasury. Additionally, you can also buy CDs. Right now, there's certain certificate of deposits that are offering 3 to 3.3%. After the next Fed rate hike in a week, those CDs are going to yield even more. Now, I just got to address the elephant in the room here, everyone. Me suggesting that you buy a CD or a Treasury bill is not the most exciting investment advice. However, what I want you all to be excited about is the idea of liquidity and capital preservation, keeping your assets in liquid instruments like cash, like Treasuries, so you can then pounce when the opportunity comes, because we are in the biggest asset bubble of all time. When you look at the ratio of home prices and stock prices to GDP, we are at nearly 300% to GDP. That's the highest level it's ever been. It's even higher than it was in 2006 at the peak of the last bubble. So theoretically, we could be on the doorstep of the biggest asset crash of all time based on this historical data. So you're going to want the cash available to take advantage of that. And that requires having some patience, postponing that real estate purchase, postponing that stock purchase, and saving as much money as possible. But I know a lot of you want to know about timing. And of course, no one knows timing for sure. But one thing I'm actually going to be looking for is for when the Fed eventually pivots away from their rate hike regime. Like, we know they're going to hike rates next week here in September. They're probably going to hike rates in November. They're probably going to end 2022 around a 3.5% Fed funds rate, with the 6-month Treasury bill probably being above 4%. But at some point, probably in early 2023, the Fed is first going to stop hiking, and then they're going to start cutting. And that's going to be a sign to me that the crash is about to get bad, because when the Fed pivots, historically, that's usually a sign that the crash is going to get really bad. Like in 2007, 2008, the Fed pivoted about 1 year before the job losses really got severe and the home prices really started going down a lot. And so important you all remember that a Fed pivot historically is a sign that things are going to get worse. A lot of people misinterpret that. They think just because the Fed saved the market in 2019 and 2020 during the pandemic, that a Fed pivot means things are going to be good. No. Usually a Fed pivot, whenever they stop raising rates and then start cutting, usually that means bad things are ahead. So be on the lookout for that Fed pivot. Probably not going to happen for another 3 to 6 months, but when it does, that's going to be something that says to me, job losses, asset crash is going to enter the next stage and get much, much worse. Now, one last thing, everyone. I want to finish this video off by giving you guys even more insight into the mind of a Wall Street real estate investor, because I know many of you are buying in cities where you're competing with Wall Street investors, and I want to explain to you why I'm so confident that these investors are bailing out of the housing market right now and will continue to bail out of the housing market. And so if we go back to this graph we looked at in the beginning, comparing the 6-month Treasury yield, the yellow line, to the cap rate or the profit on single-family homes, the blue line, the problem we observed earlier is that right now in 2022, it's basically as profitable for an investor to just buy a short-term bond as it is to buy a home, and thus that's going to lead to lower demand. But I want to explain actually why investors bought into the housing market in the first place. But if you go back to 2020 and 2021, when the cap rate was 4.6% and the 6-month Treasury yield was 0, well, investors were earning a big premium back in 2020 and 2021 due to the artificially low interest rates. So this was a period where it did make sense for investors to buy homes, and this is kind of why investors raised so much capital during the pandemic to buy homes. And if we go back actually 8 years, we can see for most of the last 8 years, the cap rate has been substantially higher than the 6-month Treasury. But this is all changing now. The more that this yellow line, the 6-month Treasury yield, goes up, and the more that this cap rate stays low, stays stable, the bigger the housing crash is going to be. And really, the only way to solve this issue for investors in the housing market more broadly is for the cap rate to go up and the return to go up for owning a single-family home. And the easiest way for that to happen is for home prices to crash. That's the path of least resistance for restoring equilibrium and balance to the US housing market and for investors looking to buy into the housing market. And oh yeah, by the way, the regular home buyer needs home prices to crash as well, because with mortgage rates going up so high, with the typical mortgage payment up 50% year over year, the regular home buyer is also priced out of the market. So we're in this interesting situation where both the regular home buyer and the investor is priced out of the US housing market in 2022. The only other time this has happened is 2006, and we all know what happened after 2006. So like I always say, everyone, if you're someone looking to buy a home or make an investment purchase, use data, especially this long-term historical data. This is going to help you make a better home buying and investment decision.